Hello everyone and welcome to Bald Guy Money. I am Bald Guy, and in my last video, I talked about how I expected the price of gold to react to yet another destabilizing geopolitical event, that of course being the tragedy we saw in Russia last weekend, which was just more bad news on top of persistent inflation concerns, a steady trend of fiat currency debasement happening all around the world, central banks continuing to buy up gold in anticipation of the consequences of the inflation, the fiat debasement, as well as these geopolitical issues, and all of this is happening while gold continues to put in bullish technical trading patterns in the charts, which are indicating a longer-term upswing in the price of gold, which is exactly why I told you all last week that I was deploying my dollar cost average budget on gold while markets were closed. And I have that purchase here with me now. I hope you can see it there. It is a 1 ounce Canadian maple leaf coin, which ended up being a very solid entry point that I'm very happy with. And if you want me to continue sharing entry points for gold and silver here on the channel, please let me know in the comments. I can do that, but only if you request it. And to those of you who bought with me, I want to congratulate you all, because when we look at the 30-minute market intervals here on the screen, you can see that we opened at the $2,164 per ounce level, and we really never looked back despite an underwhelming 24 hours after markets initially opened. Now, this marks a new nominal all-time high for the price of gold in US dollars, and really every other global currency for that matter. And as you can see here, gold has even surpassed 3,000 Canadian dollars per troy ounce and is up in Canadian dollar terms 110% over the last 10 years. As Canada has endured a massive expansion in the money supply there, and that's why the price is up 110% over 10 years versus only 72% in US dollar terms. And I'm sorry to all my Canadian viewers out there, I know there are many of you, and I'm sorry that I have to report this, but it's important for everyone to understand what is happening. But where this is leading me to is this. Gold is becoming unaffordable for the average person, and as I said, central banks are vacuuming it up at rates we have not seen since mercantilism was the leading global economic policy. Yes, I'm going all the way back to mercantilism because one of the defining characteristics of mercantilism was that the amount of gold a nation controlled dictated how much power it had. And from my point of view, it's not likely to get much better for the average person as they fight with the consequences of inflation on one side and getting priced out of the gold market by major market players, including nations' central banks, on the other side. So, in this video, I want to explore the proof we have that indicates gold is slowly becoming unaffordable for the average person. I want to discuss whether silver will follow in gold's footsteps as gold prices push more precious metal stackers in the direction of silver. And just before we get to this video's viewer question, I want to reveal the indicators I look at, and I'm looking at them right now. I'm monitoring them on an almost daily basis that I think will signal silver's next move up in price. Now, just before we get into it, if you're in the United States and want to purchase gold or silver from a reputable dealer at a fantastic price, please check out channel partner Pimbex, who currently has these beautiful silver Morgan rounds from the Regency Mint for as low as $26.61 per ounce. I really like these, and having recently made a gold purchase, I won't hide the fact that I am shifting my focus a little bit to silver right now. So if you're looking for some proper silver at a reasonable price, unlike the $33.67 silver eagles I saw this morning from another dealer's website, and that dealer shall go unnamed, give Pimbex a shot and click the link in the description below to this fantastic offer, or just visit their site to see what other great offers they have. And remember, if you're interested in a gold or silver IRA, call them at the number on the screen for a free consultation. Just be sure to let them know you came from the Bald Guy Money channel. Okay, so to start, what proof do I have that gold is becoming unaffordable for the average person? Let's start with the fact that 44% of Americans, citizens of one of the world's wealthier nations, can't afford a $1,000 emergency. I've talked about this in the past. Now, for those of you watching outside of the United States, I want you all to convert whatever $1,000 is in your head to your local currency. And ask yourself right now, ask yourself the question, can the average person in my country afford that type of emergency? Because unless you're watching from Switzerland, Luxembourg, or Monaco, I am guessing the answer to that question is no, which means the average person really can't even purchase a half ounce of gold, which at spot price would be more than $1,100 today, and that's pretty sad. Now, continuing with this American example, when we exclude access to credit card debt, half of Americans don't even have $500 in cash savings, which means they can't even afford a quarter ounce of gold if they were so lucky to have it offered to them at spot price today. But for me, the most telling number that indicates just how unaffordable gold is becoming is when we calculate how many ounces of gold can be purchased with the American annual personal income. And to make that calculation, we are looking at US per capita annual personal income since 1971, and we're dividing that number by the price of gold at the time to figure out if the amount of gold a personal income can buy is going up or is it going down. And as you can see on the chart here, the amount of gold you can buy with the per capita annual personal income in the United States today is 31 ounces. And that number is going down, and it is lower than any other period I measured in the last 40 years. And what I want you all to notice is that we're really starting to enter territory not seen since 1980, and I'm going to touch a little bit more on that in a moment. But for everyone watching this video, take note, because the 90s and early 2000s, when central banks were net sellers of gold and trust in US debt instruments was high after the collapse of the Soviet Union, everybody, those times are gone. And this trend of gold becoming increasingly unaffordable is one that I expect to continue, and it's telling us some pretty important things about the economy and how money will work in the future. So coming to the list of things I want to cover here, the first thing this is telling us is that we've gone back to a 1980s stagflationary type of economic environment, and I've talked about the other signs on the channel before, but in a nutshell, this is a situation in which inflation is high, economic activity slows down, and wages remain more or less the same. And I think we can all agree that we are seeing those three things play out around the globe right now, and the price of gold versus per capita personal income perfectly underlines the situation we're in. And this is a kind of analysis you're not going to see in the mainstream media. You're not going to see it on CNBC, because this is not the kind of news they want to deliver to you right now. So, moving on to point 2 on the list, when I factor in the many macroeconomic and geopolitical issues happening in the background right now, again, I have to say that I do not expect this trend to reverse, because for this trend to reverse and head back towards the 1990s or early 2000s type of scenario, we would need to see central banks start offloading the massive amounts of gold they've been buying up. And if that's something you're waiting to see happen, let me tell you that the gold they're buying is staying in the safe, and more gold is on the way to join it. And unless wages miraculously start to go up, even as automation and artificial intelligence continue to take jobs, expecting gold to become more affordable, in my opinion, is not a reasonable expectation. Now, the last point on this list of how I interpret this data is more of a glimpse into the future of where I think this could lead us, and there is historical precedent for it, and I will cover that too, but this could push gold into a territory where it becomes a medium of exchange used mainly by elites. So I'm talking major companies, and I'm talking the central banks of major nations. And I'm not saying this to make anyone afraid. I'm not trying to sell fear on this channel. And I'm definitely not telling you that gold is going to disappear. But in a world where inflation is higher than interest rates, we may see a future where less large transactions are done in fiat currency and instead are settled in some kind of gold-backed currency, whether government issued, as has been speculation with what the BRICS nations are potentially trying to do, or maybe that will be privately issued gold-backed currency on the blockchain, as I've discussed in past videos right here on the channel. Now, no matter how that ends up happening, I want to say that there is historical precedence that I want to cite in this video to illustrate to you all how this has actually functioned in the past. And that example is the example you see here, and it's from the Roman Empire. I've done some videos in the past about ancient Rome, about ancient Greece. Many of you know I collect ancient Roman coins. Now, what I want to say on this point is base metals back in the Roman times were used by common people for day-to-day transactions. And we may just get to a point in the future where this is going to be the sole role of fiat currency or CBDCs, potentially if they're going to be introduced. This could be the role that they play in the future. Whereas gold and silver, and we will dig a little bit deeper on silver in a moment, but back in the Roman times, gold and silver were used by the wealthier classes for more significant transactions, as well as to store wealth in. And when it comes to wealth storage, you would see the wealthier Roman citizens storing their wealth in gold coins, and maybe the more average Roman citizen hoarding away some of the silver coins. Now, to close the topic of gold before we move on to silver, this is why I say having gold in a stack, even fractional gold, is key to having a healthy, well-rounded stack of metals. And that's something I've been saying in a lot of my videos over about the last year and a half. And it's a point that I want to drill home right now. But where does that leave silver? Is silver going to follow in gold's footsteps and become less affordable for common people over time? Or is it going to languish and never actually repeat what we're seeing happen with gold right now? Let's take a look. So here is the same chart I showed you for gold, which shows the amount of silver you can buy in troy ounces using personal income per capita data. And as you can see here, we are not quite at the levels of unaffordability that we're seeing on gold, but silver today is technically less affordable than it was in 1971 when Richard Nixon took the United States off of the gold standard. And in comparison to the 1990s and early 2000s, silver is becoming significantly less affordable, because where personal income per capita today will get you 2,780 ounces of silver, that number was nearly 5,000 ounces of silver as recently as 2005. And that matters because if your intention is to get ahead of the curve and buy before price moves, if you don't want to end up being the person who says, oh, I should have bought gold in 2016 and 2017 after the big pullback after the metals blow off top, or how many times have I heard people say, oh, I should have bought Bitcoin at such and such price. If you don't want to be that person, if you don't want to be the person saying that, when it comes to silver, please consider these 2 points. The first being that the 30-year trend confirms that silver, like gold, is becoming less affordable. Now, will it become as unaffordable as gold is today? Only time will tell. But moving on to the second point, it's clear that silver is undervalued or underpriced, whatever term it is you like to use, versus gold today when we measure it this same way, using it versus US per capita personal income. Silver has not behaved the same way gold has recently, at least not yet. And part of the reason for that is because of central banks. Again, as I've said countless times on this channel, they do not stack silver. And no matter what other YouTubers may tell you, it doesn't make it true. Remember, those are the same YouTubers who were promising you $1,000 silver just a few years ago. And those are the same YouTubers who just last weekend were telling you that the price of gold was going down. So, just be careful about who you're listening to out there on YouTube. But what I want to say is that that although silver has lagged behind gold, mainly for that reason that I just stated, there will come a time when the ratio between silver and gold starts to narrow again. And as promised, just before we get into the viewer question for this video, here are the data points I watched to help me predict the trajectory of the price of silver, starting with the PMI Global Manufacturing Index. This index measures manufacturing activity around the world. A reading above 50 means there's manufacturing growth. A reading below 50 means manufacturing is contracting. And silver price, statistically, does much better when this index is above 50. And we have been at 50 or below on this index since September 2022. But the trend is reversing, and if you want to know more about that, I will cover it in depth in a Patreon video this week. Link to join is in the video description and the pinned comment. But moving on to the next data point I watch, it is the large bank and regional bank ETFs. And why I watch them is because shakiness in the banking sector is always a precursor to large moves up in the prices of precious metals. And these are my canaries in the coal mine that tell me how confident the market is in private banking. Whether that confidence is justified or not, by the way. But as these ETFs fall, that is a sign to me that maybe there's some doubt about the health of these institutions. And we saw these ETFs tank in March and April of last year as precious metals flew up. And even though they may not have a huge impact on gold these days, the performance of these ETFs' impact to the price of silver is, in my opinion, significant, and it's why I watch them. Finally, the other indicator I watch to predict the trajectory of silver prices is investor demand. And although we don't have any fresh data coming out of the Silver Institute right now, there are ways to track this, whether it's deliveries being executed on futures contracts or simply watching movement on silver premiums offered by bullion dealers. These are indicators that tell us how strong the silver investment market is and is usually a leading indicator to larger price moves, whether in the upward or downward direction. Now, just before we move on to the viewer question for this video, please let me know if this type of information is useful, and I will also be sure to share more of my indicators with you all in the future. Just let me know in the comments again to give me some feedback on the content. Okay, so moving on to the viewer question for this video, and remember, I answer one question in every video I do, so leave your questions in the comments section, and you may just see it appear in the next episode of Bald Guy Money. You never know. This week's question comes from Endra Harimurti. I hope I said your name correctly. Hello, Endra. And Endra asked, on the next bust, like the one we saw in 2008, we may see metals go down for a short period of time. If I sell my metals before the bust, will it be easy or hard to buy them back once the bust happens? Awesome question here about timing the market, and I have received this question so many times, and my answer to it has many layers, starting with the fact that many rules have changed since the 2008 crisis and Great Recession, and this is why we shouldn't look for an exact recreation of the 2008 metals price crash to happen, because the rules defining collateral eligibility, and I know it's confusing, but basically what this means is the collateral eligibility defines what a bank can borrow against. And those rules have changed dramatically since 2008. And although I'm not going to get into the specifics of it in this video, I have been through many documents on the topic. This is one example I covered in a Patreon video, and I will leave the link to the document in the video description for some of you more ambitious viewers who are interested in reading and understanding how these rules changed. But essentially, the changes that were made make it easier for central banks to print money and prop up the private banking system, making the participation of bullion banks in supporting private banks almost unnecessary today, whereas it played an important role in the 2008 crash. So that's the bit on how private banking won't necessarily be the catalyst to cause the same scale of price crash in the prices of gold and silver that we saw back in 2008 this time around. Now, can we see prices pull back at more modest levels in a future crash? The answer is absolutely we can. In fact, after gold's amazing run last week, and I'll put the image back up on the screen for you all to see, we may even see a little consolidation and a retest of the $2,200 level this week. But when it comes to the overall trend, it's clear we're moving up on metals. As a result, time in the market is going to be timing the market every single time, especially when you're talking about physical metals that come with a premium when you buy them. In fact, the only thing I'm trying to time right now is my purchases. I'm trying to find the best entry points before bigger price moves up, or I'm trying to nail the pullbacks. Now, if you sold at these prices and a pullback happens, would you be able to buy your metals back? Because ultimately that's what you've asked. And I'm saying the answer to that question is yes. Of course you'd be able to buy them back. But for many viewers, such a sale would trigger capital gains tax obligations, not to include already the price of the premiums that I've already just mentioned. And there's really no guarantee at what price you're going to be able to buy the metals back at. And that's why I am accumulating gold and silver right now. I am not selling with some grand plan to buy back at a lower price. Because if you like volatility and you like quick gains, gold and silver are probably not the investment or savings mechanism you want to be in. For get rich quick on high volatility, you may want to consider the Geo Bowden crypto token, which is up almost 1,000% over the past year. And of course, this is a bit of a joke. I would never own or encourage someone to buy this, so I don't want to hear in the comments section that I'm telling you guys to buy Geo Bowden coin. But I am trying to make a point, and the point is that gold is not a get-rich-quick scheme, and trying to time the market with physical bullion can get you burned, just as I expect many of the people who own this Geo Bowden token are going to get burned sometime soon enough. So with that said, that's it for this video, everybody. If you found this content informative or useful, hit the like button, share the content with other people, or leave a comment. Make some noise, please, for the algorithm. Let YouTube know that more people need to see this content and help Bald Guy Money continue on a fantastic growth trajectory. And thank you all to the people who have been loyally doing that. I really appreciate you all, because we're growing at a fast tempo and we're really getting, in my opinion, level-headed information about the economy and about precious metals out to people. And that's all thanks to you who have been making noise for the algorithm. So thank you all. And until the next time we see each other, everybody, I want to say, as I always say at the end of all my videos, take care of yourselves and take care of each other. Goodbye.